Welcome to Module 9 of the QuickBooks Accounting Software training. In this module, we're going to look at management accounts, and our focus is going to be on some of the key considerations to make for your working capital management, including cash flow projection. My name is Lilian Katiso. I'm a financial management consultant and QuickBooks trainer. In Module 9, we're going to look at accounts receivable. This one, we're going to look at the number of days it generally takes your customers to pay you. We're also going to look at the accounts payable. How many days on average do you take to pay your suppliers? We're also then going to look at the cash flow projection. How do you have a good balance between when you expect to receive payment and when you make payments out to your suppliers, and also other payments that you may need to run your operations. Okay, so we're going to look at how to do cash flow projections. But for those who are VAT registered, we're also going to take you through how to generate the VAT report for filing. Okay, as usual, I'm going to share with you my home screen for QuickBooks so that I can take you through the step-by-step on how to go about these reports. Okay, so as usual, we start from the home page, where it's more like our landing page. So from here, you can navigate through the icons directly to the different things and to the reports. On the upper toolbar, that's where the reports are. And we're going to go to reports, and we go to accounts receivables, which is under customers and payables. And we're going to look at the top one, accounts aging summary. So the account aging summary gives you the details of the people who owe you money and for how long they owe you. As you can see, it is spread out, broken down as we've covered in a previous module. What I'm going to do is to collapse it so that you can have a summary. Okay, so when you collapse it, you have a summary of the report. By default, the report is alphabetically organized, but you can change and have it in order of which one, who owes you the most money or who owes you the least money. And as shown in the previous module, you can select that by going to sort by total, and then you can choose ascending or descending order. Okay. Now, in terms of management, you want to see who owes you how much money and for how long do they owe you. Okay. Because if you're making considerations on extending credit period, then you want to see who is owing you, for how long are they owing you. But also, in case you need to make provision for bad debt, then you know what to consider. Okay, so this is one of the reports that shows you who owes you currently, the current period. In between, these are now the ones that were raised in that particular day that you're looking at the report, between 1 and 30 days, 31 to 60 days, 61 to 90 days, and above 90 days. If you want to see for more than 90 days, of course, further to 365 days, you just add to 365 days and refresh that, and you get a lengthier report that shows all those details. Okay, so this is a report that you may look at. Now, from here, it is not easy for you to know what's your average days it takes for customers to pay you. So there's another report that shows you that one, and that is the reports. Go back to reports, under customers and receivables, there's a report called average days to pay summary. Now, in this average days to pay summary, it shows you Edwin Co pays you on average in 6 days, Andre pays on average in 16 days, 54 days. Now, the one that is showing negative means that they paid their account in advance. Okay, and then they're waiting for invoices to offset the payments that they've made in advance. So that's why it looks like they paid. There's a negative pay days. Okay, but this gives you a total, and then you have an average of 34 days. Now, as management, then you have, I believe, you're benchmarking what is a good average to pay days. Mostly people consider for average days for receivables is 30 days. So if you find that this is higher than what you expect, then you work on how do we make it better. Okay, so those are your considerations for average days for collecting money. But if you want to look at this in terms of the people who owe you money, but you want to look at them in terms of graphical representation, so you go straight through to reports, and then you come to accounts receivable by graph. Now this one, it shows you a pie chart, okay, which shows you who owes you the biggest part of the pie, followed by, the different color codes that are shown there. On the right-hand side, you can see Cathy Classics owes the most. 38% of the accounts receivable is owed by Cathy Classics, followed by Zen, and then Milborn, continuing like that up to a group of others that is lumped up here in a very small percentage, okay? So in terms of giving efforts in collecting, you know where to lay emphasis, that I need to collect. I need to put more emphasis to collect from Cathy, to collect from Zen, or whoever it is. But remember, this is just showing the current percentage of who is owing you right now. Okay, it is not showing for how long it's been outstanding. This is just showing who is owing you the most. Now, if you go back to this other report, you can see Cathy's, they owe you the most, but they take on average 54 days to pay you, which is higher than an ideal 30 days. So we need to have a conversation on how or incentivize them on how to pay you sooner, because they are holding 38% of your money, of your receivables, and they're taking on average of 54 days to pay. But if you go back to this other report, Cathy Classics, it's Cathy Classics. So this one is, they owe the most. You can see them here at the bottom. And you can see this thing has been outstanding. They have an outstanding of more than 365 days of $47,000. And if you scroll this other side, they have recent invoices. Okay, so you see they have a recent invoice that was issued of $63,000. I'm going to reduce this so the window is smaller, of 90 days, instead of looking at the 365 days. Now, if you look at Cathy Classics, as much as they owe you the highest, okay, but you can see how the bill is spread out. So the biggest percentage of this money is on a recent bill. So maybe then management will need to have a conversation of when are they planning to pay this old outstanding bill, but also what considerations are being made for them to be given this additional amount of money. Okay. So when you're setting up the days, when you're determining who to give money to give extra days to pay, at the customer center, okay, we had shown that if you go to Cathy Classics, go to, is it Cathy? Okay, so under Cathy Classics, we can get information about this particular customer, and you can actually decide to set up some more information about them. So you click here on edit, under edit. Okay, so you can choose payments. Under payment settings, you can put a credit limit, okay, so that you can show how what is the extent of credit that you need to give this particular customer. Okay, so that's one of the ways that you can control, so that you don't have your debtors stretching you too much. Okay, so all the other information we have covered in the previous detail on how you can track your debtors and set limits for them. Okay, so that is on the accounts receivable, how you can track them and how you can monitor them. And this also helps you to know on average how much do you collect on every other month, how much is outstanding for you to collect on the different months, and put an effort in collecting the receivable. Okay, so now going to the accounts payable. Still going to the top tab under reports, there's accounts payable. Okay, under suppliers and payables, there's accounts payable summary. So this also gives you a list of the people that you haven't paid. Okay, so it shows you this is current obligation. This one has been outstanding, $10,000 has been outstanding between 30 and 60 days, 61 to 90 days, and more than 90 days. Okay, this is what is outstanding for more than 90 days. And this column shows what is outstanding for total. The same way you can, in terms of your cash flow management, you might opt to pay the ones that have the older bills, okay, followed by the ones that are not so old, depending on your payment terms agreement with your supplier. And also you can get a report for that in a graphically represented report. This is, and still the same place, go to suppliers and payables, accounts payable summary, and then you go to accounts payable graph. The accounts payable graph, you can see, yes, you owe Sanjeev is owed the highest at 41%, and then you have the breakdown of all the other people that are owed, okay? And so depending on what your payment plan is, you might choose to decide how to make payments. Okay, so once you have your accounts receivable checked out, and you have your accounts payable checked out, and you've confirmed that these are the correct balances, then now we go to the cash flow forecasting. Cash flow forecasting, you go to company, under company, we go to the same place we went to look for the budgets, under planning and budgeting, and then there's a cash flow projector tool. Okay, so this cash flow projector tool that QuickBooks has covers a 6-week period, okay? Assumes that you're projecting for the short term. And it uses information that is based on the data that you already have in your QuickBooks. So how up-to-date your cash book is matters, how up-to-date your debtors and your receivables are matter as well. So the cash flow projector reads your QuickBooks data to project and model your cash flows. It creates a summary based on the for the requirements based on a 6 weeks projection. It will look at your cash at hand, incoming cash, and business expenses and accounts payable. Okay, so this is, let me just show you a sample of how it looks like. So once it's done, this is how it looks like. It will have the different weeks, 6 weeks, and then it will have your cash, the beginning cash, the receipts that you're projecting to collect in that particular week, and any adjustments, which would be either a loan injection or capital injection. Then business expenses, your overhead expenses, if you have credit card payments, rent, payroll, costs of goods sold, or you have some purchases to make. All these ones that are not under your payables will be shown here under business expenses. And then the payables that are pending from the payables accounts payables report, those are listed here. Now, depending on what your terms of payments were, they will be projected in the different weeks that those amounts fall due, okay? But when you do the cash flow projection, you can actually edit and project them to when the cash allows you to pay them, okay? So let me just close this, and we have got this, okay? So we are going to do a demo. Now it picks information from the current information you have in QuickBooks. So for example, this one is based on our current balance in the current account, that we have in the system. Now you can choose also to include the undeposited funds, but if you don't want to plan to include the cash flow planning, including the undeposited funds, you can untick that one, and our focus is only $77,675. If anticipating a loan or something like that, maybe of $10,000, or I put 20, yeah, $10,000, it means you can make that as an adjustment. So when you make that as an adjustment, it means the money you currently have in your cash book, okay, your current resources, and an adjustment of maybe what you're anticipating to get within the next 6 weeks gives you available beginning balance as $87,000, okay? Then we go to the next step. Now, at this point, you can choose how you want to have your cash flow projected. So in this one option is to use the average weighted for the last 6 weeks. So over the last 6 weeks, this is according to this file that we're using, we've been getting an average of 14,433. But you can actually type in manually. If you don't want to use the weighted average, you can say I'm anticipating that in the next week I'm going to get $15,000. The following week I'm going to get $16,000. The other week maybe it may drop down to $14,000, and like that, okay? So that's how you can project. But also you can say I'm expecting some particular cash receipts, okay, that are not part of this weighted average projection, and they're not part of this projection that I've put, but I'm just expecting some money in the different weeks that are to come. You can put the amounts there. Maybe I'm expecting a $1,000 somewhere or $500 somewhere. So this adjustment allows you to adjust based on the reality that you are, okay, your best guess, best guess scenario for what you're anticipating, okay? You go to next. Then here is where you put the business expenses. So you have, let's say, a weekly car expense, maybe fuel every week is $100. You have telephone, a monthly bill of $75. You have rent monthly of $1,000. You have payroll of about $5,000. So whichever other expenses you have, you just keep on adding them with the drop down. Maybe you have a staff training coming up, and this is not it's coming up, let's say, on the next week. Okay, so let's look at the data set was in December, so let's assume that it's coming up here. But now this one is not a monthly occurrence, it's a one-off occurrence. So you choose one time, okay? It's not a monthly occurrence, it's a one-off occurrence, let's say $1,000, okay? So you can project items that occur weekly, those that occur monthly, those that occur once in a while. So you can estimate the frequency of the occurrence of that particular expenditure. If it is one-off, you put it. If it is if it is monthly, daily, if there's something that you pay daily, you can include that as well. Okay. So this information is picked from your, is picked from where? It's picked from your chart of accounts. It's picked from your chart of accounts, and you just project, okay, so this expenditure, I want it to, the date when I want for it to start, it could be from the 1st, but I want the meals are paid maybe to the supplier on a weekly basis, and we pay about another, let's say $500, okay? So you can go on and choose the different things, okay? And even for the business expenses, if there's something that is not listed up there, an occurrence that you're anticipating to happen, you can pick it up and put it under the adjustment. Then we go to next. Now, once that is done, then you have the suppliers. This picks from your suppliers ledger. So you can choose, depending on the resources that you have, you can choose, okay, when to make payment. For example, this one is showing that the due date for this one is on the 6th, okay? So if it's on the 6th, you check if you're not able to pay it by the 6th, you can actually extend to pay it on another day, if of course you've negotiated with the supplier maybe to change the date, okay? So each of the different suppliers, you can, and even the amount, you can negotiate with them and say, okay, maybe I'm paying this particular amount, and let me project this one to another week. Let's say this one is going to be on the 12th when it's actually falling due. Okay, so you keep on scheduling the different days until you are happy with the dates when you're supposed to make payment. Okay. Now, this should have been done, of course, when you've done your supplier ledger reconciliation, so that you have the right data. So once you're done, you click finish. So when you click finish, it's going to give you a report. So the beginning cash balance, okay, remember where we put 87, we had 77, and we added a 10,000. So that gives our beginning cash balance, okay? And then the cash receipts are projected based on the information you can either use a weighted average or you can type in the figures when you anticipate that. So it gives you the total cash for each of the different periods. So this beginning cash for this particular week becomes the opening of the following week, plus the receipts of that week and an adjustment of money of $1,000. We are anticipating to be having $103,000. Then you, of course, make out payments for that particular week, okay? And then also the payables that are going to happen that particular week. Then you have an ending cash balance. Now, the essence of the cash flow projection is to look at this ending cash balance. At all times, you have to check that you're not having an ending cash balance of negative, because of course that will be not advisable. So as you're doing your cash flow projections, you check that your ending cash balances are positive. But also this helps you to see, do I have enough money to be able to maybe pay more suppliers, or maybe I had a capital expenditure that I've been postponing to pay, but now I have enough money to pay. So maybe I needed something to pay of maybe $20,000, but I didn't know when to make a payment. So from this, it can show you, okay, you can actually be able to absorb that capital expenditure, okay? So once you're happy with this, you do what? You can save as a PDF, or you can print it, or you can email it to the people who are concerned, okay? So that is the cash flow forecast, okay? And it's a tool that you can use for projecting how to collect. So this also bear in mind that if these collections don't come as anticipated, it means therefore it may affect the cash that you're expecting at the end of the period, which means therefore you may have to adjust either the payables or the business expenses, okay? So that is your cash flow projection tool that you can use, okay? So if there's something you needed to change, you can always edit until you finish, okay? So we're going to close that projection for now. Okay. So that's done for the cash flow projection. Now, for those who are VAT registered, you can come here under VAT. There's a VAT tab up on top here. So there's a VAT detailed report. So under VAT detailed report shows you the VAT for the period that you're looking at. Of course, you have to choose the period. You can either say, I want to look at last month. The data set we have is December, so last month then is November, or you can choose the period by selecting. Let's say you actually want to look at December. So you just select that data set, 1st of December to, 31st of December. Okay, and then you refresh to get that report. Okay, so this gives you all the transactions that have VAT on them. So shows you the details of the transactions, the transaction number, the receipt number, the VAT rate that was applied, because you might have more than one VAT rate. Okay, or you might be having standard rated, exempt supplies, zero rated supplies. So here it shows you the rate. And then here shows you, this column shows you the net of VAT. And this other column shows you the actual VAT amount that was levied on that particular receipt. Okay. So it will list all the VAT, output VAT, as we call that. Okay. And then at the bottom here, it will show you what your total output VAT is. In this case, it's 11,193. Okay. Then against that, it also lists for you the input VAT. So all the purchases that were made, the details of the purchases, who they were made from, and also the VAT that was charged on that, okay? And then it shows you the input VAT out of that, okay? The rest here is just, so this other part shows you both the net VAT and the amount. Boxes. Okay, so this is the box 4, and this other one is box 1. Okay, Now, the rest of the details is just giving you, if you wanted to get the total of your net amount, okay? So it gives you the total of your net sales, net of VAT. It gives you the total here is $65,000, and the net for purchases is $5,000. So what would happen then? You export this to Excel, okay? So you come here and you create a new worksheet, export this to Excel, and then from the Excel, you now upload it to the VAT template, because Uganda Revenue Authority has a VAT template that they expect you to populate and put in the information there, okay? So that is how you export, you generate your VAT report, and you export the report to Excel, and then you use it to file your return. Okay. So going back to the accounts receivable. In this accounts receivable report, let me just collapse it, okay? So when you're looking at your accounts receivable report, you'd look and see that you have some balances that are small balances, okay? And it might be that actually they don't, Edwin Co doesn't owe you the $21.23. It could be that that is withholding tax that was left on the account after they paid an invoice. So many accountants normally ask me, how do I treat withholding tax in QuickBooks? Because the customer has paid, so the balance is still there in the accounts receivable, but I'm not going to collect it. In that case, you have to pass a journal. Under company, okay, there is make journal entries. Come here to make journal entries. So you have to choose which is the date when you're making that particular journal entry. And so it means that this customer's account is going to be accredited. So under accounts, I'm going to credit the accounts receivable. Okay. So I'm going to create accounts receivable with the account was 21.23. Okay. So this is the withholding tax. In Uganda, withholding tax is 6% of net of the amount. So if they withhold 6% withholding tax on invoice, you put the invoice number, and then you choose which customer withheld that from you. So that is Edwin Co. is the one who withheld that amount from you. And then the account you're going to, this is going to be credited, 21.23, and the account you're going to debit is withholding tax claimable, because the withholding tax amount is the amount is tax held in advance by the customers, and so that money is kept on your tax account or your tax ledger. When you file your corporation tax at the end of the year, you can offset that amount of money. But you just need to clean your ledger that you're not going to click to get this money from Edwin. But also it helps you to collect how much you need to offset on your corporation tax at the end of the year. Okay, so we're going to save this. Okay, so we had closed the period, so that's why it's alerting me. Remember, you set closing dates, so I'm putting a transaction, a period that is closed. You say yes, you refresh the report. Now, if you refresh the report, you realize now Edwin Co has no balance. Yes, they don't owe you any balance, but still, they're still appearing on your debtors ledger. Okay, so you don't want them to appear on the debtors ledger with a zero balance. It's because the journal has not been offset, the invoice. Okay, so in that case, what you'll have to do is come to the customer's ledger, customer center, and then we go to Edwin Co's account. Okay, so if you go to Edwin Co's account, you see they have a zero balance. Okay, but we have to offset the amount that they have paid this journal that we've passed for withholding tax. So what you need to do is to receive the payment from Edwin Co against the invoice. Okay, so under customers, we receive payment. When you go to receive payment, we go to Edwin Co. And it's going to show us that Edwin Co. has a credit, an available credit of 21.23. Okay. Now on the upper tab here, there is discounts and credits. So you click on discounts and credits, and it shows you there's available discount that was raised on journal GG, yeah, on that journal number 3. Okay. And so you can choose to apply that discount. So you click done. Okay. So what is going to happen? It is going to show that this amount was due, but it's going to be offset on by against a credit. Okay. So we're going to save that and close. Okay. So if you had closed a period, it means every time you make an adjustment, you have to do what? You have to go and put the password so that you're not having someone putting a transaction in a period that has already been passed. So now you can see here in an accounts receivable, Edwin Co is not listed here, okay? Because they have already been cleared. Now, in our chart of accounts, if you go to the chart of accounts, you'll see accounts withholding tax claimable. So here it is tracking for you all the withholding tax that is claimable. So at the end of the year, you can just come here and get a report, a quick report on the list of all this one. We only have one that you've done for the example, but you can generate a list of all the withholding tax claimable, okay, to show you the period and the customer who withheld it from you, and you can use this list to offset your corporation tax. Okay. So that is it for module 9, where we have looked at accounts receivable, how to look at your accounts receivable days, and also how to look at your accounts payable and schedule how to pay them, and also how to look at your cash flow projection, how to do your cash flow projection, and how to generate your VAT report. And also as a bonus, how to pass a journal entry. Okay, so thank you very much for watching. I'll see you in the next module.